I was looking at the global balance sheet this morning, just trying to wrap my head around where the world actually stores its wealth.
Right.
And, we spend so much time talking about the stock market, the S&P 500, bond yields, the crypto casinos. We obsess over the daily ticker tape.
We do.
But when you actually stack up the chips, you realize we're focusing on the small change.
We usually are. It's a matter of visibility versus value. Stocks tick every second, so we watch them.
Yeah, exactly.
Real estate, it just sits there for decades, so we
Yeah.
tend to ignore it. But, I mean, get this. If you take every stock certificate, every corporate bond, and every ounce of gold ever mined in human history,
All of it.
pile them all up,
Mm.
you get to a value of about, $221 trillion.
Which is an unfathomable amount of money. It's almost abstract.
Is until you look at real estate.
Mm.
Global real estate, commercial, residential, agricultural, the land itself
Yeah.
is valued at nearly $400 trillion.
400 trillion.
$393 trillion to be precise. It is nearly double the size of all those other major asset classes combined.
Wow.
It is the single largest store of wealth in human history, period.
It's the elephant in the room that we treat like a piece of furniture.
Yeah, that's a good way to put it.
And that's why I wanted to do this deep dive today. Because we aren't just looking at houses, we aren't looking at office buildings.
Yeah.
We are looking at the operating system for the world's largest asset class, and specifically one company that has decided it wants to be the Microsoft or, I don't know, the Apple of that $400 trillion pie.
CoStar Group, ticker CSGP.
Right. And the reason we're looking at them today specifically is because of this stack of documents from late 2025 and this month, January 2026. Because something shifted. I read through the Q3 earnings, the investor decks, and it feels like the company just flipped a massive switch.
They call it a strategic inflection point,
Right.
which is usually, corporate speak for we messed up and we're trying something new.
Usually, yes. It's usually code for a layoff or a desperate pivot.
But in this case, it feels different. For the last 3 years, CoStar has been in what I'd call war mode, just burning cash.
Lighting money on fire.
Literally. Lighting money on fire to build a residential portal to fight Zillow. But the 2026 guidance says the war phase, or at least the heavy spending phase, is over.
The investment phase is done.
It's done. They're moving from burn to earn.
And the numbers they're projecting, I had to double check this. They're guiding for an 83% jump in EBITDA in a single year.
That's the claim. An 83% increase.
In 1 year.
From roughly $400 million to nearly $800 million. They're telling Wall Street, the heavy lifting is done. The foundation is poured. Now watch us harvest the profits.
So that's our mission today. We need to figure out if this is hubris or if they've actually built a machine that can dethrone Zillow and print money at the same time. Because when you peel back the layers, this isn't just a tech story. It involves a literal Air Force, a billion-dollar lawsuit, and a fundamental philosophical battle over who owns the data about where we live and work.
And it all starts with understanding that CoStar isn't really a residential company, at least not historically. Right. To understand where they're going, you have to look at the engine room.
The commercial side.
The commercial side. This is the cash cow. CoStar is often referred to as the Bloomberg of real estate.
I hear that comparison a lot, the Bloomberg of X. But what does that actually mean in practice? Because a Bloomberg terminal is a, $25,000 a year necessity for a trader?
Absolutely.
Is CoStar really that essential?
Think about it this way. If you are a commercial real estate broker, you sell office towers, you lease warehouses, your entire value proposition is knowing things other people don't.
Information arbitrage.
Exactly. Who owns that building?
Wow.
When does the lease expire? What did the guy across the street pay for rent per square foot? What are the comps?
And you can't just Google that.
You absolutely cannot Google it. It's private data. CoStar has spent 30 years and billions of dollars building a database of every commercial property in the United States and the UK.
30 years.
They have 182,000 subscribers. And these aren't casual users, just browsing. These are brokers, lenders, appraisers.
Professional.
The professionals. If you take CoStar away from them, they are flying blind. They cannot do their jobs.
So it's not a nice to have, it's a utility, like electricity for their business.
Precisely. And because it's a utility, they have immense pricing power. The margins on this business are just staggering.
What are we talking about?
We are looking at 47% margins for the CoStar suite.
47%. That's software territory. That's a beautiful business model.
It is. And the revenue is sticky. It's incredibly sticky. 92 to 96% of their total company revenue is recurring subscription revenue.
So it's predictable.
Very predictable. This is the bank. This commercial business generates the cash flow that allows them to go out and do crazy things like buying Super Bowl ads or suing their competitors into the ground.
I want to touch on the resilience of this commercial side because for the last few years, the big headline has been the death of office.
Right.
Everyone works from home. Office towers are ghost towns. If I'm CoStar and my core clients are office brokers, shouldn't I be panicking?
You would think so. The narrative was pretty dire. But the data from late 2025 is showing something very interesting. They call it green shoots.
A recovery. Or just wishful thinking.
Now, it looks like a real stabilization. In the third quarter of 2025, transaction volumes in commercial real estate actually increased 54% across subsectors.
54%. That's not a green shoot. That's a forest growing back.
It's a huge jump. It signals that the market is reset, prices came down, there was a lot of pain, and now buyers are stepping back in.
The bottom is in? Maybe.
It might be. The CFO, Christian Loan, he mentioned on their earnings call that for the first time in his tenure, it feels like they are on the other side of the downturn.
And that's critical.
It's absolutely critical. If the commercial engine is revving up again, that cash cow gets even fatter.
Which gives them even more ammunition for this residential fight.
Exactly.
But CoStar isn't just a data terminal. They also run marketplaces. LoopNet.
Right. If CoStar Suite is the research tool, LoopNet is the advertising billboard. It's where you list a commercial space for lease or for sale.
It's the public-facing side.
Correct. And they've done something very clever with the pricing here that I think explains their whole philosophy.
The silver membership push, I saw that in the notes.
Yes. In most businesses, you want to upsell the customer to platinum, right? The highest tier.
Always. More features, more money.
CoStar is actually trying to push customers down to silver.
That seems completely counterintuitive. Why would you ever take less money?
Because of churn. It's all about churn. A platinum listing is usually for a specific vacancy.
I have an empty floor. I pay platinum to fill it.
Exactly. And once it's filled, what do?
You cancel the subscription. You don't need it anymore.
Precisely. Platinum retention is in the teens. It's incredibly volatile revenue. But a silver membership is for a whole portfolio. It's a branding play for the brokerage firm itself.
Ah, so it's always on.
It's always on. You keep it active all year round to market your firm and all your properties. The retention on silver is 80 to 90%.
So they are trading high volatility, high dollar revenue for slightly lower, but rock solid, predictable revenue.
They're optimizing for stability. They want that recurring revenue line to be a straight line up and to the right, always.
That makes a lot of sense.
And then, of course, there's apartments.com.
The Jeff Goldblum empire.
The Brad Bellflower campaign.
I have to admit, those ads are burned into my brain. But was it actually a good business move? A lot of people saw it as this huge, risky spend.
It's the case study for everything they are doing now in residential. It's the proof of concept. When CoStar bought apartments.com in 2014, it was a distant player, a nobody.
What kind of revenue did it have?
It had only $75 million in revenue. Nobody really cared about it. Today, it's a juggernaut. It's on a $1.2 billion run rate.
From $75 million to $1.2 billion.
Yes. They turned a small player into a monopoly by simply outspending, outmarketing, and out-innovating everyone else.
There's a note here about apartments.com being counter-cyclical, which, again, feels like it shouldn't be true. If the economy is bad, shouldn't a rental website suffer?
It's the beautiful irony of advertising. Think about it from the landlord's perspective.
Okay.
When the economy is booming and everyone has a job, apartments fill themselves.
Right. There's a line out the door.
You stick a for rent sign in the window and it's gone in an hour. You don't need to pay Jeff Goldblum to find you a tenant.
Your marketing cost is zero.
Zero. But when the market softens, when vacancy rates rise, which we saw happening in 2024 and 2025, landlords panic. They have empty units costing them money every single day. They have to advertise. They have to pay apartments.com.
So the platform actually has more pricing power when the market is struggling.
In a down market, they become an essential service. It's a brilliant hedge. The core data business is steady, and the marketplace business thrives when things get tough.
It's a fortress.
It is a financial fortress. And now they are taking that fortress and aiming the cannons at a new target.
Which brings us to Section 2, the residential moonshot, the war for homes.com.
This is the big one. This is the trillion-dollar question. Can CoStar do to Zillow what they did to the commercial market and the rental market.
So let's set the scene here. We all know Zillow. It's a verb. I Zillowed that house. My mom uses it. My friends use it. Why does CoStar think they can beat a verb?
Because they believe Zillow's business model is fundamentally hostile to the people who actually pay the bills, the real estate agents.
This is the "you're listing your lead" concept.
It sounds like a marketing slogan, but it's actually a deep philosophical difference in how the internet should work for real estate.
Okay, break it down for me. I'm a homeowner. I want to sell my house. I hire a listing agent. Let's call her Sarah. Sarah is great. She takes the photos. She writes the copy. She stages the living room. She puts my listing on Zillow. What happens next?
In the traditional Zillow model, what they call the premier agent model, you, the buyer, see the house online. You love it.
I love it.
You see a big friendly button that says Contact Agent. You click it, thinking you're going to talk to Sarah, the person who knows everything about the house.
But I don't get Sarah.
No. You get put into what the industry calls robocall center hell.
Okay.
Your information goes to a premier agent. You get a call from a random realtor who has paid Zillow thousands of dollars a month for the exclusive rights to that zip code.
So it's an advertisement slot.
It's an ad. That agent might be 20 miles away. They might have never set foot in the house you're asking about. Their only goal is to capture you as a buyer client.
So Sarah, my agent, did all the work. She created the product, but her work is being used as bait to generate a lead for her direct competitor.
You've got it. CEO Andy Florence calls this lead diversion. He argues it's actually deceptive to the consumer because you think you're reaching the source of truth, and it's insulting to the listing agent.
It's like, imagine if I wrote a book and Amazon put a button on my books page that said contact author, but when you clicked it, it connected you to a ghostwriter who tried to sell you their book instead.
That is a perfect analogy. It's using one person's creation to sell another person's service.
And that is CoStar's opening.
That is the wedge they are driving right into the heart of the industry. Their pitch to agents is simple. We don't steal your leads. On Homes.com, if a buyer clicks Contact, that lead goes directly to Sarah, the listing agent.
For free.
For free. No strings attached.
Okay, but if they give the lead away for free, how does CoStar make money? Zillow makes billions selling those leads. Is CoStar running a charity?
Definitely not.
Yeah.
They're much, much smarter than that. They're shifting the monetization. Instead of charging for the lead, the outcome, they charge for the branding, the exposure.
So it's a subscription model.
It's a membership model. If Sarah wants her face to appear more often or her listings to be at the top of the search results or have a more enhanced profile, she pays a subscription.
It's the difference between a slot machine paying per poll and hoping for a win and a gym membership. Predictable cost.
And agents seem to prefer the gym membership. It's predictable costs versus highly variable and often very expensive costs per lead. And the numbers back this up.
CoStar claims that agents who use Homes.com are winning 60% more listings.
60%? That seems incredibly high. Why?
Think about the pitch. You're an agent sitting in a living room trying to convince a seller to hire you.
Okay.
You can say, if you list with me, I will put your home on Homes.com, where every single buyer inquiry comes straight to me, the person who knows your house best. I can sell the features we just discussed.
Right.
If you go with the other agent who relies on Zillow, your home, your beautiful kitchen you just renovated, is just going to be used as bait to feed leads to random agents in the next town over who don't know anything about your property.
That is a very compelling pitch. It aligns the platform with the listing agent, not with a random buyer agent.
Exactly. And the math supports it. Zillow's model really only works for the top, say, 5% of agents who have huge budgets to buy leads.
The big teams.
The big teams, the big brokerages. CoStar's model, in theory, appeals to the 100% of agents who have listings. They are going for the volume play. But does it work? I mean, are people actually using Homes.com? Because I, like many people, still type Zillow out of habit. It has incredible brand recognition.
The habits are breaking. The traffic numbers from 2025 are startling. In Q3, Homes.com reported reaching 115 million monthly unique visitors.
115 million, and that's more than a third of the U.S. population. That's a huge number.
It is a massive number.
Yeah.
And here is the trend line, which is even more important. While Homes.com traffic rose 8.3%, Zillow's traffic actually dropped 6.5%, and Realtor.com fell 0.7%.
So they are actively taking share. It's a zero-sum game for attention.
They're definitely grabbing eyeballs. And more importantly, they're converting those eyeballs into agent bookings. Net new bookings grew 53% sequentially in the third quarter of 2025.
So agents are signing up, they're buying the subscriptions.
They're buying in. And I assume the marketing blitz has something to do with this traffic. We all saw the Super Bowl ads with Dan Levy and Heidi Gardner.
Oh, absolutely. That's not an accident. CoStar hired the former CMO of Geico, the Gecko guy.
The Gecko and the Caveman. This is a guy who knows how to build massive brand awareness very quickly using humor and saturation.
And it worked.
It absolutely worked. Unaided awareness, meaning if you ask someone on the street, name a real estate website, and they say homes.com without any prompting, that metric jumps from 4% to something like 33 or 42% in under 2 years.
That's insane.
That kind of brand build usually takes a decade.
But spending $1 billion on ads is the easy part, right? Anyone with a big enough checkbook can buy a Super Bowl ad. Making money on it is the hard part.
And that brings us to the strategic inflection point, Section 3. Because 2026 is the year the checkbook closes, or at least gets put back in the drawer for a bit.
Show me the money.
For the last 2 years, CoStar has been in what they call peak investment, burning cash to build traffic and brand. Now, the guidance for 2026 is a hard pivot. They are reducing net investment in homes.com by $300 million.
That's a massive cut. Does that mean the ads stop? Does the traffic crash? That's the bear case, right?
That's the risk. That's the whole bet. But the theory is that they've reached escape velocity. They built the brand awareness. They've established the habit in a large chunk of the population. Now they don't need to shout quite as loud to maintain it.
And the revenue is starting to kick in.
And simultaneously, the revenue from those thousands of agent subscriptions is stacking up. The curve is crossing.
So let's look at the financial guidance again. Revenue projected at $3.78 to $3.82 billion. That's 18% growth year over year, which is strong. But the profit, that's the headline.
The adjusted EBITDA, that's the number everyone is looking at. $740 million to $800 million.
Which is an 83% increase from 2025.
An 83% increase. This is the hockey stick chart that investors dream of. It's the moment the rocket ship leaves the launch pad and actually reaches orbit.
And they aren't stopping there. The long-term plan is even more ambitious. They have a target of 35% margins by 2030.
If they hit that, this becomes a phenomenally profitable machine. Just like the commercial side, a true second engine for the company.
And to prove they are serious, they announced a massive share buyback.
A new $1.5 billion share repurchase program.
Buybacks, the ultimate vote of confidence from a management team.
It says, we think our stock is cheap because you, the market, don't realize how much money we're about to make.
I also noticed a note in the filings about activist influence. Third Point is involved, the hedge fund.
Yes, Third Point is a well-known activist hedge fund. They took a stake and pushed for a governance overhaul. You can see their fingerprints all over this new capital allocation plan and the new compensation plan.
The symmetrical slope comp plan. That sounds like a geometry problem.
Glasses. It's actually very clever and very shareholder-friendly. In a typical CEO pay package, if the stock goes up, you get rich. If the stock goes down, you still get paid a lot, maybe just a little less.
Right. It's all upside. Heads I win, tails I don't lose.
Exactly. The symmetrical slope means executives get paid based on total shareholder return and earnings per share. If the stock goes down 20%, their pay goes down 20%. If it goes up, their pay goes up. It's a one-to-one relationship.
So it deeply aligns the management team with the shareholders.
It puts immense pressure on Andy Florence and the team to deliver these 2026 numbers. There is no place to hide. Their own wallets are on the line.
Okay, so the financial story is we built the factory, now we run the factory for profit. But to keep that factory running, you need a competitive advantage. You need a moat. And this is where the story gets really weird and interesting.
You're talking about the Air Force.
I want to skip ahead to this because it just caught my eye in the operational expenses. Because when you analyze a tech company, you expect to see servers, software engineers, maybe some sales commissions.
Sure.
I do not expect to see a line item for aviation fuel.
The CoStar Air Force?
Is this literal? Do they actually have an Air Force?
They do. It's one of the strangest and most effective moats in the entire business world. They operate a fleet of research planes.
How many?
Along with 421 photographers on the ground and in the air. It's a massive operation.
Okay, play devil's advocate for me here. We have satellites, we have Google Earth, we have drones that can fly anywhere. Why on earth is a data company in 2026 paying for pilots and jet fuel? It feels so archaic, like delivering mail on horseback.
It feels that way until you understand the speed and granularity of data. Satellite imagery is great, but it's often 6 months old.
Mm.
It's static.
Okay.
CoStar's planes are flying low-altitude patterns over active growth corridors constantly, every day. They're looking for one specific thing: dirt moving.
They're tracking bulldozers from the sky.
They're tracking supply before it exists. Think about it. If you are a commercial developer or bank deciding whether to lend tens of billions of dollars for a new shopping center, what is your biggest risk?
That someone else builds a bigger, better shopping center right next door and kills my rents.
Exactly. You need to know about shadow supply before it hits the market. If CoStar's plane sees dirt moving in January, they log that into the database. They tag it as proposed construction. That is months, maybe a full year, before a permit is fully filed with the county or a leasing sign goes up.
So they are selling you a time machine.
They are selling certainty.
Huh.
And that creates a data moat. Because if you want to compete with CoStar, you can't just scrape the web. The data isn't on the web yet.
It doesn't exist in the digital world.
It only exists on a hard drive in a CoStar plane. To compete, you have to build your own Air Force. And nobody can afford to do that.
And this connects to the lawsuit, doesn't it?
Yeah.
The billion-dollar suit against Zillow.
It's the core of it. CoStar treats this proprietary data like the Coca-Cola recipe. It is their crown jewel.
So what's the accusation?
In July 2025, they sued Zillow, alleging that Zillow's rental platform, which they were trying to build out, was populated with images and data points that, according to CoStar, could only have come from their database.
So we flew the plane, we took the picture. How did it end up on your website?
That's the essence of the claim. They identified over 46,000 proprietary images and data points.
And this isn't just a slap on the wrist. CoStar plays for keeps with litigation.
They use litigation as a business strategy. Do you remember a company called Xceligent?
Vaguely. They were a competitor a few years back in the commercial space, right?
They were the main competitor in commercial data. The Pepsi to their Coke, CoStar sued them for copyright infringement on photos and data.
And what happened?
The legal fees and the eventual judgment were so massive that Xceligent didn't just lose the case, they liquidated. They filed for Chapter 7 bankruptcy. They effectively ceased to exist.
So when Andy Florence, the CEO, says Zillow is under siege, he's not just using tough language, he's threatening them with corporate extinction.
He is trying to create a legal moat around his data moat. If Zillow can't get data from CoStar and they can't afford to fly 400 planes, where do they get the comprehensive data they need? It forces Zillow into a very, very difficult position.
But the moat isn't just physical planes and lawyers. They also bought Matterport. This is the more modern, techie part of the strategy.
This is the digital side of the moat. Matterport is the gold standard for digital twins.
3D tours, I've used them. You click through the house like you're in a video game. It's a cool feature, but is it really a game changer?
For CoStar, it's not just a cool feature. It's a defensive weapon against the biggest threat of all, AI.
Against AI, how so?
Think about the Google threat that hangs over this entire industry. The existential fear is that AI will just scrape all the data from the internet, the photos, the descriptions, the prices, and present it to you directly in a Google search result.
The AI overview scenario. Google eats the middleman. You never need to visit Zillow or Homes.com again.
Right. But AI can only scrape what is easily accessible: text, 2D images. It cannot easily scrape or replicate a proprietary, dimensionally accurate 3D model of a home that lives inside a proprietary player.
So by having the Matterport 3D twin, you force the user to come to Homes.com to actually experience it. You can't get that immersive experience on a Google search page.
Exactly. It walls off the most engaging content. It makes your site a destination, not just a data source. And it works. The data shows that average session duration on Homes.com increased to 4 minutes and 29 seconds in Q3 2025.
Wow.
That's up 93% year over year.
Because people are playing inside the dollhouse. They're measuring walls and seeing if their couch will fit.
They're emotionally investing in the space.
Yeah.
And while they are inside that dollhouse, they are seeing the listing agent's face. They're clicking contact. It deepens the engagement and reinforces the "you're listing your lead" model.
So they have the Air Force, they have the digital twins, and they have the lawyers. It sounds pretty airtight, but we have to look at the other side, Section 5.
The bear case.
Because there are plenty of smart people betting against this whole story.
There are. And their arguments are compelling. We have a report here from an analyst group that refers to CoStar as banana stand capital. They have a sell rating on the stock.
There's always money in the banana stand. I like that. So what's their argument?
Their core argument is basically diversification.
Diversification. Explain that.
CoStar has this amazing high-margin commercial business. We talked about it, 47% margins. It's a near monopoly. Why on earth would you take the profits from that incredible business and dump them into the residential market, which is lower margin, fiercely competitive, and highly cyclical?
It's like owning a mint that prints money and deciding to use that money to start a chain of restaurants. Restaurants are a hard business.
It's a brutal business. Exactly. The bears argue that CoStar is moving from a great business to a merely good business, and that dilutes the overall quality of the company. They are chasing revenue growth at the expense of return on invested capital.
And the valuation reflects that expectation of growth, right? The stock is expensive.
It's priced for absolute perfection. CoStar trades at a massive premium, something like 61x to 85x earnings, depending on how you measure it.
Which means the market is already expecting them to win big if they stumble. If that EBITDA number for 2026 comes in at $600 million instead of $800 million,
the stock gets crushed. There's zero room for error in this story. And there's a huge execution risk here we haven't touched on enough. The human element. They are hiring hundreds of people a month.
750 new sales reps targeted.
Just think about that. We talked about the efficiency of the software, but you can't just download a sales culture into 750 new people. When you scale a sales team that fast, productivity usually plummets.
You get chaos.
You get chaos. You have rookies selling to rookies. It is incredibly difficult to manage that kind of growth without a serious dip in quality and efficiency.
And then there's the biggest moat of all, which belongs to Zillow, the muscle memory problem. I typed Zillow into my browser yesterday without even thinking about it. I didn't search for houses for sale. I searched for Zillow.
That is the hardest moat to cross. It's brand equity. 80% of Zillow's traffic is organic. It's free. People go there directly.
Right.
CoStar has to pay for every eyeball with Super Bowl ads and expensive search engine marketing. The billion-dollar question for 2026 is, what happens when they turn down the marketing spend? Does the traffic stay, or does it evaporate overnight?
So the bet for 2026 isn't just can they build it, they've built it. It's can they make it stick without spending $1 billion a year on commercials?
And that is the whole game. Can they change consumer behavior permanently, or was it just a sugar high from the ad spend?
And we haven't even really touched on the Google threat we mentioned earlier, the disintermediation risk.
It hangs over the whole industry like a storm cloud. If Google decides to prioritize its own carousels of homes in search results, pulling data from the MLS feeds directly, Zillow and CoStar both lose. They become just another data source for the Google machine.
CoStar argues their proprietary data, the Air Force photos, the Matterport scans, is the hedge against that.
They do. They say Google can't show our proprietary 3D tours. But you should never, ever bet against Google's ability to change the rules of the internet to their own benefit.
So to sum it up, we have a dominant commercial monopoly pivoting to take on a household name in a trillion-dollar turf war. We're calling this the extraction era.
That's really what 2026 represents. It's the moment of truth. CoStar spent decades building the data machine. They spent the last 3 years building the residential platform. Now, they're turning the key to extract the value.
It's an asymmetric opportunity, isn't it? The downside is they burn a few $1 billion. The upside is they control the operating system for a $300 trillion asset class.
It is. And you have to look at their track record. They bought LoopNet when it was a #2 or #3 player. They turned it into a monopoly.
Yeah.
They bought Apartments.com when it was small and insignificant. They turned it into a giant.
They've run this playbook twice before.
They have run this exact playbook twice before, successfully. The bet is, can they do it a third time with the biggest prize of all, residential housing?
And if they win, what does that mean for the industry? I want to leave the listener with that thought because it's bigger than just one company's stock price.
It could be the fundamental disruption of the buyer agent.
Oh.
For decades, the real estate transaction has had two agents, one for the seller, one for the buyer. If the your listing, your lead model truly wins, if the consumer gets used to going directly to the listing agent because it's faster, more accurate, and more efficient, do we need the buyer's agent anymore?
The agent who drives you around in their car for 6 weekends.
Right. Historically, that agent held the keys to the kingdom. They have the MLS data. But if the data is free and universally accessible on a site like homes.com and the contact is direct to the source, their value proposition shrinks dramatically.
So CoStar might be positioning themselves as the savior of the listing agent.
But they might be the accidental executioner of the buyer agent.
Or maybe they are just the final step before the total digitization of the transaction. Maybe in 10 years, we just click buy on a Homes.com listing like we click buy on Amazon, with lawyers and AI handling the paperwork in the background.
That is the ultimate vision. And whoever owns the platform when that happens, well, they win the entire game.
Risk defined, portfolio protected. That's the sign-off from one of the investment theses we read, but it feels like it applies to the whole industry right now. Everyone is digging in their moats.
And CoStar is bringing the heavy artillery.
Fascinating stuff. We will be watching those quarterly reports very closely this year. Thanks for diving in with us.
Always a pleasure.
And to you, the listener, next time you click on a house listing online, take a second to look at who you're actually contacting. You might just be stepping onto the battlefield. We'll see you in the next deep dive.